There's a pattern that repeats in every major financial bubble in history. It's not the asset, it's not the technology, it's not the sector. It is, quite simply, a phrase. A phrase that, when you start hearing it everywhere, means the end is closer than people think. In a moment, I will tell you exactly what that phrase is. But first, you need to understand what happened in Japan in the 1980s, because it's one of the clearest mirrors of what's happening today. By the late 1980s, Japan was the most envied economy in the world. Its economy had grown over 400% in just 30 years. Japanese companies dominated entire industries. They weren't just competitive, they were better. Toyota made better cars than Detroit. Sony made better electronics than anyone in America. Japan bought iconic assets around the world, including the Rockefeller Center in New York. There were plans for the biggest tower, the largest airport, the most advanced infrastructure. This wasn't confidence, this was certainty, and the market reflected that. In 2000, investors poured $82 million into a company that sold dog food online. And then it finally went public. And it was dead 9 months later. But this video isn't just about that one company. It's about the companies everyone believed were different. The ones smart investors, billion-dollar institutions, and Harvard-trained fund managers were certain could never fall. But the truth is, they did fall. Some lost 80, 90% of their value in less than 2 years. And do you know what the worst part is? It's happening again right now. And most people are making the exact same mistake today. There's a pattern that repeats in every major financial bubble in history. It's not the asset, it's not the technology, it's not the sector. It is, quite simply, a phrase. A phrase that, when you start hearing it everywhere, means the end is closer than people think. In a moment, I will tell you exactly what that phrase is. But first, you need to understand what happened in Japan in the 1980s, because it's one of the clearest mirrors of what's happening today. By the late 1980s, Japan was the most envied economy in the world. Its economy had grown over 400% in just 30 years. Japanese companies dominated entire industries. They weren't just competitive, they were better. Toyota made better cars than Detroit. Sony made better electronics than anyone in America. Japan bought iconic assets around the world, including the Rockefeller Center in New York. There were plans for the biggest tower, the largest airport, the most advanced infrastructure. This wasn't confidence, this was certainty, and the market reflected that. At the peak in 1989, the Nikkei index had risen 800% over 2 decades. Japanese stocks traded at an average of 60 times earnings. For comparison, even today, during one of the most optimistic periods in the US market, the average is closer to 25. At one point, the land under the Imperial Palace in Tokyo was worth more, on paper, than the entire state of California. And these weren't speculative startups. These were real companies, profitable, established, dominant. Mitsubishi, Hitachi, Nomura, companies that had been around for decades. It felt absolutely impossible for companies like these to fall. On December 29, 1989, the Nikkei closed at its all-time high. The very next day, the market started to fall, slowly at first. Analysts called it a healthy correction. Fund managers called it a buying opportunity. The headline said Japan was simply pausing before its next surge. Then the market dropped 20%, then 30%, then 50%. And the tragedy is, it just didn't stop. By 2003, the Nikkei had lost around 80% of its value. It took an incredible 34 years just to recover. An entire generation of investors never saw the market return to where they bought. And you might be thinking, Japan was different. There were structural issues, cultural rigidities, economic imbalances, and you'd be right. But there was something else, the same phrase that appears in every bubble before it bursts, the one I mentioned earlier. You've probably said it yourself at some point. Before I reveal it, you need to see what's happening in the US market today. Because once you see it, you won't be able to ignore it. In 1989, the 5 largest companies in Japan made up about 45% of the entire market. Today, the 7 largest companies in the United States make up over a third of the S&P 500. Back then, analysts said Japanese companies were structurally superior, that their model gave them advantages the West couldn't replicate, that their growth was sustainable because it was driven by real productivity. Today, analysts say American tech giants are structurally superior, that platform businesses have advantages no one else can replicate. That growth is driven by artificial intelligence. NVIDIA trades at around 50 times earnings, Tesla over 100. People say they're expensive. But then they add something else, 4 very simple words: And those 4 words are, this time is different. Those 4 words have appeared in every financial bubble in history. Economist John Kenneth Galbraith spent decades studying market crashes and came to a simple conclusion. Every bubble is built on the belief that the rules no longer apply. First, there were the famous tulips in the 1600s. Then came the massive railroads in the 1800s, radio stocks in the 1920s, real estate in the 2000s. And most recently, we saw crypto in 2021. Each time, there was a rational, intelligent, and convincing explanation for why things were different. And every time, they weren't. Now, to be fair, these are extraordinary companies. NVIDIA is remarkable. Apple changed the world. Microsoft is deeply embedded in the global economy. These are not fragile businesses. But the problem has never been the quality of the company. The problem is the price people are willing to pay when they believe quality justifies anything. In 1989, Sony was an extraordinary company. It still exists today, it's still relevant, it still makes money. But investors who bought at the peak waited decades just to break even. So the real question isn't whether great companies survive, it's what price you're paying. I'm not saying the market will crash tomorrow. I don't know when it will. No one does. Anyone who tells you they know is either lying or trying to sell you something. But what I do know is this: crashes don't announce themselves. They happen when people are still buying, still confident, still repeating the same phrase, this time is different. So the real question isn't, will the market fall? The real question is, if it drops 50%, what happens to your financial life? If that answer makes you uncomfortable, it might be worth rethinking how you're positioned. Not because the end is near, but because smart preparation doesn't require certainty about the future. If this made you see something differently, share it with someone who needs to hear it. And tell me in the comments, what's one asset people today believe can't go down?